Crude oil is still flowing, but it's wearing new flags, sailing longer routes, and dodging sanctions with the precision of a chess grandmaster. Welcome to the Saigal Seatrade podcast. I'm your host Shruti, and today we are peeling back the layers on the world's most complex trade energy. And with me is shipping expert Mr. Sandesh Ghandat. And trust me, you'll want to hear what he has to say. Because if you're a trader or a ship owner, this isn't just about barrels and rates. This is about the global order and how it's shifting, one cargo at a time. Welcome back, Sandesh.
Thanks, Shruti. Thanks for inviting me once again, and we have a lot to unpack today.
So let's start with what everyone's talking about, the EU's latest sanctions. We have seen 18 packages and yet Russian crude still flows. Why haven't those sanctions worked the way policymakers hoped?
Well, Shruti, that's a fantastic place to start, and because on paper this looks like the most aggressive move, yet cutting the oil price cap to $47.60 per barrel, and then in addition to that blacklisting over 100 tankers, and then banning refined products made from Russian crude in third world countries within 6 months looks kind of a sketchy, but let me paint the real picture here. Now, since the original $60 per barrel cap was introduced in way back December 2022, we have seen the Urals trade consistently below it. And then 2 weeks back on July 18 this year, it was assessed at $58.48 per barrel FOB Primorsk basis. So this new floating cap, it just narrows the gap but doesn't close it. And what's more astonishing is the market's response. Russian crude export by sea, it still averaged around 3.4 million barrels per day. And that is in May 2025. So product exports like diesel and VGO still hitting 1.8 million barrels per day. And then you may ask how? We call it as a refinery camouflage. Once Urals enter in a CDU, that is crude distillation unit, in countries like Turkey, India or China, and then it goes into the FCC or hydrocracker, you can't tell the origin of the molecules anymore. And then traders blend it with the Bonilite or Kazakh CPC, and then they swap components in Fujairah or Taman, and cargoes are relabeled in Singapore, sometimes Turkey and sometimes in India. So that's how Russian origin diesel still lands in ARA, that is Amsterdam, Rotterdam, Antwerp, despite these bans. So we are looking at a market that evolved faster than the rules can catch up. The tanker system, it remains agile, inventive and resilient. We have a shadow fleet tonnage and it is now over 640 ships. It is strong, up 100% since 2022, and that's lifted Russia's ton-mile demand by nearly 23% year on year. So in a word, no, the sanctions haven't worked because historically they never worked, and because the enforcement mechanisms, they haven't matched the market's ingenuity.
Well, it's mind-blowing to know how the markets have cashed up. Now to shift to India, it's Russia's biggest oil buyer. Yet there's growing pressure from the US and the NATO. Can India keep up with this dance, or are we reaching a tipping point?
Well, Shruti, India is playing a very sophisticated balancing act, and currently around 45% of its crude imports is coming from Russia. That's huge, especially when you consider that before the Ukraine war, that number was just below 2%. Now, even with the EU sanctioning Naira Energy's Wadena refinery, India has made it clear that energy security comes first. In fact, it has expanded its sourcing base from 27 to over 40 countries. So we are talking new suppliers like Guyana and then doubling down on Brazil, Canada and African producers. But here is the real threat. The Sanctioning Russia Act of 2025 in the US, if passed, it could impose tariff as high as 500% on countries that continue trading with Russia. And you know what? India is one of the major countries. The bill has already 82 out of 100 senators supporting it. And you know what? That's a serious political momentum. And yet, we see that India is pushing back. It argues rightfully so that the EU continues to buy Russian gas while penalizing oil buyers like India. So that's the double standard, and that's what I want to focus on. Indian Oil Corp or IOC has said it can revert to its pre-Ukraine sourcing model if needed. But let's not kid ourselves that replacing 45% of national supply overnight isn't easy. And that amount 45% is somewhere around 2.5, 2.6 million barrels per day. And it was especially when The freight markets are tight and alternative grades are more expensive. So India currently hedging, the momentum is there. It's lobbying in Washington, it's diversifying in upstream and maintaining the optionality. But if those tariffs become law, we will see major cargo rerouting, and that's going to shake the entire tanker market.
Well, Sandesh, you mentioned Russia's exports holding up. But what about its actual production? There's growing chatter that flaring data and quota numbers don't add up. What's the truth?
Well, Shruti, this is where the things get really fascinating. Officially, Russia produced around 8.97 million barrels per day. The data is from May 2025 and close to its 8.998 million barrels per day quota. Satellite flaring data tells a different story. The World Bank's 2024 Global Gas Flaring Tracker shows a steady decline in Russian flaring, which is often used as a proxy for upstream activity. So less flaring usually means less drilling or fewer wells producing. So when we saw Moscow's momentum, Rosneft executives dodged all questions during the recent press conference about the capacity and investment. Russia simply doesn't have the flexibility that Saudi Arabia does. Saudi Arabia, it can wrap up 2 to 3 million barrels per day within no time, or we can say less than 15 or 17 days. And then Russia, maybe 0.5 to 1 million barrels per day. And if that, so that is still a question lingering. And with a strong ruble, sanctions and underinvestment, so their marginal barrel is expensive. And this really matters because as OPEC Plus unwinds its 2.2 million barrels per day in voluntary cuts through mid-2026, the market will expect Russia to deliver. But it may not be able to do so, because that's the X factor, and it could cause a major supply shocks if global demand rises beyond IEA's 104 million barrel per day forecast for Q4 2025.
Well, now let's zoom out a bit and talk tankers. Despite sanctions, VLCC earnings are strong. Aframaxes in the Mediterranean are surging. How is the market holding up so well?
Well, resilience is the word, Shruti, and freight rates have defied the gravity. VLCCs on AG China, they hit $45,000 per day in July. That's a 30% growth year on year. So Suezmax and Aframaxes, they are riding high, and specifically in the Med, which is again 27% up month on month. And why? Because longer voyage lengths due to the sanctions are increasing the ton-mile demand. A barrel that used to go from Russia to Europe now takes a shadow route to India, then to Singapore, and then the Med, and that's, extra selling time. Plus, shadow fleet tankers, they are inefficient. They are older, they are slower, they are riskier. They inflate the supply curve, but, not the velocity. Meanwhile, sanctioned barrels still move just under the different flags. And then don't forget about China. It has hoarded around 1.14 billion barrels of crude onshore. So their inventory is one of the largest in the recent history. And that's just a 19 million barrels shy of its satellite visible limit. So if China slows its buying or procurement pattern, we will see 10 fewer VLCCs a month in demand. And you know what? That's massive.
So now, let's wrap with this big picture. With Brent around $70, OPEC Plus easing cuts, and inventories tight, what does 2026 look like for the global oil and shipping?
Well, you know what, Shruti? The market is walking a tightrope. On a surface, the Brent forward curve suggests a moderate strength of $68 per barrel on a 3-year view. But we have got a razor thin space capacity, or the spare capacity is just 2.3 million barrels per day globally. And then we have OECD inventories. They are 5.1% below the 5-year seasonal average. And then forecasting to 2026, it could be messy, and OPEC Plus is set to unwind the final 0.55 million barrels per day of its cut packed by September. So that adds supply, but it's not necessarily where it's needed. So Russia may fall short, the US shale growth is slowing, and then Canada's oil sands face an infrastructure limit. But on the flip side, if Iranian exports fall deeper than expected, or if China restart its stockpiling in first quarter of 2026, that is next year, we could see the Brent spike to $90. So, in summary, the bottom line is this: volatility is the new normal, and for ship owners, traders, and refiners, that means opportunity.
Thank you, Sandesh, for giving us that overview. And today we have Sagar with us from the LNG chartering desk at Saigal Seatrade. Sagar, welcome to the Saigal Seatrade podcast.
Hi Shruti, thank you for having me today, and I'm happy to give my inputs.
Well, LNG used to be the sleepy cousin of oil. Now it's the headline act. What's driving this surge, and especially in Asia and Europe? What do you think, Sagar?
You are right, Shruti. It's not just about LNG anymore. It's geopolitical LNG. In the first half of 2025, the US supplied 57% of EU's LNG imports, which is up from 46% last year. That is around 27% of total EU gas imports. And Norway still leads with 30%, but the US is catching up very fast. Why? Because Russia's pipeline is politically toxic. And LNG offers flexibility. The EU doesn't want to be held hostage like it was in 2022. So terminals like Świnoujście in Poland and Eemshaven in the Netherlands are working overtime. Meanwhile, Asian LNG demand is climbing too. Spot prices are hitting $13.2 in Northeast Asia in July 2025, which is up from 8.5% month over month. And this is being driven by two key things. First is China's strategic restocking, especially in petrochemical heavy coastal regions. And the second thing is Korea's economic rebound. In second quarter, GDP grew 0.6% quarter on quarter, and LNG imports are surging with it. Shipping-wise, the LNG carrier market is tighter than ever. Ton-mile demand has ballooned with US Gulf to Asia voyages, replacing shorter intra-EU or Russian pipeline routes. Even with 3 LNG tankers delisted from the EU sanction in July, capacity remains stretched. Freight rates are holding steady in the $130,000 per day range for modern DFDE or MEGI vessels on long hauls to East Asia. In short, we can say LNG is not just bridging energy gaps, but it is rewiring trade flows.
Well, that brings us to the end of this episode. And to all our listeners, do not forget to share and subscribe to our podcast. And until next time, navigate safely and stay tuned.